All right, let's go ahead and get started for today's Around the Valuation International webcast. My name is Chin Chun and I'm with NACVA and the Consultants Training Institute. Before we get started with the Around the Valuation World International today, I want to go over a few housekeeping items. First, to obtain CB credit, you must answer all the poll questions that will pop up on your screen during today's webinar. If you have an ABW International subscription, CP certificates will be available to you through the NACV.com portal within 7 to 10 business days. If you have any questions during today's webcast, please use the Q&A feature in Zoom, as those will be directed to the presenter. If you have any questions about like any technology questions or questions about NACVA, feel free to use the chat feature in Zoom, as those will be directed to me. All right, with NACVA, with the Around the Valuation World and the Around the Valuation International webcast, we try to highlight a lot of the upcoming trends or current issues that come up in the industry. We can't cover all of them. However, we did provide you with a link in materials, which will direct you some articles and different publications where you can get more information about different resources and upcoming events or anything in the industry, like upcoming trends. This page shows our editors. We have Wolfgang Nies, Andrew Newman, Pratik Shah, and also Brian Jones, who is our advisor. I believe Pratik just joined us, but we do have Wolfgang, who is also joining us today. This is our lineup for today. We just have a few little GACV news item, and then we have Dr. Ashok Abbott, who will be presenting the Margrave exchange options, discount for lack of liquidity. And with that, just want to give a quick little reminder. We do have one conference coming up. The conference will be hosted in Las Vegas at the MGM Grand. The date of the conference will be December 12th to the 13th. There is a discount available. If you look at the bottom of the screen, and it's also included in your materials. So if you take advantage and register before May 31st, we'll take advantage of that discount. If you are a member of another chapter, please reach out to your chapter, as there may be some additional discounts that may be available to you, because we know that travel expenses can be a little costly. So, and with that, I'm going to turn the time over to Wolfgang Nies, who will get us started with the presentation today. And yeah, thanks, Wolfgang.
Yeah, thank you. Thank you, Chanda. Welcome to our May Around the Valuation World International show. I would like to add one conference announcement to Chanda's slide as well. If you are staying in Europe or are interested in traveling to Europe, the EACVA conference will be held in Düsseldorf, Germany on the 5th and 6th of December. We are nearly finished with the program, and we will upload all the information on the website valuationconference.de within the next weeks. So please feel free to have a look if you are interested in. So now it's a great pleasure for me to introduce Dr. Ashok Abbott. He's with us today. He is Associate Professor of Finance at the West Virginia University in Morgantown. He received his MBA and PhD in finance at the Virginia Polytech Institute and State University. His dissertation was on the valuation effects of tax legislation in corporate sell-offs. He has published extensively in scholar research journals and presentations at national and international conferences. He serves on the editorial board of the Business Valuation Review and the Value Examiner. His focus areas are the level of price adjustment, discounts, and premiums appropriate for especially liquidity and marketability, and identifying causal relationships among variables of interest in valuation. And he also consults for valuation divisions of well-known firms. Today, we dive a little bit in option pricing theory, and more important for practitioner, the application in the real world. And yeah, I'm having that I hand over the micro to Dr. Abbott.
Thanks, Wolf. It's a pleasure. It was really nice to see you in Florida.
Yeah.
And it's fun. Okay, so let's get started. It's can I share my screen?
Yep.
So that you can see the right. Okay.
Perfect.
You see that? Excellent. So basically, what we're looking at is for a long time, I mean, starting about 60 years ago, SEC did a study and they agreed that even in public markets, there are latencies in trading, which do create some amount of price risk, and therefore a blockage discount would be appropriate. Okay. So we need to first look at the underlying reason for saying, okay, we want to sell something. The approach would be, okay, let's look at the Wall Street Journal or online and say, okay, end of the day, whatever the event date is, it's a divorce, it's a death, it's a taxation issue, it's a gift and tax situation. IRS would say, fine, the stock traded at X number of dollars per day, you are giving 1 million shares to your heirs or in this dispute or whatever is happening, and therefore the tax obligation would be based on the price multiplied by the number of shares you're giving. Except what really happens in the real world is that even though we are using the underlying data from the capital markets for pricing the security, we're looking at betas, we are looking at risk-free rates, we are adding different kinds of size premiums. All of those are derived from the daily trading prices for securities in the public market. And here is a little look at what is really happening in those markets. Huge number of trades. If you look at it, we are looking at more than 1 million trades a day, except what we see. Even though all those shares are being traded, about per share, per trade, if you look at it, we're looking at about 100 shares, which is a minuscule proportion of the shares outstanding. The daily turnover for the markets is about the median turnover is less than 1/2 of 1% on a given day. So if we are looking at blocks of 5, 10, 20, 30, 40%, that is something which is, it would be unrealistic to say that that large an amount could be placed in the market with no incremental cost. In addition, is the issue of marketability. Even though the stock is listed, it is trading, question is, can the holder, now remember, liquidity is asset specific. And is this stock selling in the market? What is the proportion that it sells? What are the prices that it sells at? In addition, the officers, the affiliates are subject to even longer delays before they can even start selling. Now remember what has happened here. The insiders who have access to more information than the public at large are being restrained from trading large amounts of stocks over short periods of time to take advantage of that additional information that they have available. The SEC regulations are basically designed to create a fair market for participants. Not altruistic, but the idea is that if most of the investors believe that they were working at a disadvantage to the people who have more information, they would simply take their money and go home. I mean, why would you want to play in a casino where the house is always winning? Okay. So that is why these restrictions are placed, and those restrictions create this need for a discount of lack of marketability or lack of liquidity, which we have started calling blockage. So we are making a distinction between blockage when there are no trading restrictions, but the market determines how much volume can be moved at a certain price. And then the next level becomes the lack of marketability, or DLOM, discount for lack of marketability, where there are trading restrictions. So what we want to make clear is that even if there are no trading restrictions, larger volumes of stocks, larger blocks, and by large we mean anything greater than about 0.5%, are subject to significant price reduction if we want to place them on the market. Now, since in business valuation practice, we are using the numbers derived from the public markets, the valuation that we do starts at the point of the publicly traded equivalent value. What would be the value if this stock was in the public market and was being traded? Okay. So once we have that, then the next step becomes, really, how about if we have any restrictions? If you have to wait 6 months before you start selling, if you're an affiliate and you cannot sell more than 1% of the stock within every 90 days, so the same block could be getting stretched over a longer and longer period of time, depending on who the seller is. Now, as usual in practice, we always start trying to find a method in the madness. So it has become over time, and as more data have become available, obviously, we are in a better position now to assess what is happening in the marketplace. So the earliest was to quote studies. So basically, we start in about 50 years ago, 1970s, when the first organized studies were made. And then came the delisting studies, looking at, okay, this is when it is being traded and when the stock delists, because we know that about a third of the stocks trading at any point in time do get delisted between 5 to 7 years of their inception on the market. It's a continuing process. New stocks come in, they're listed, start trading. Then after some time, many of them fall out of favor or are acquired or are not traded in a large enough volume. They go dark. They are not doing their SEC filings. So about a third of the stocks disappear every 5 to 7 years. And that does give us a good starting point for saying, okay, when it was listed, it was being traded, what was the price being observed? And how did that price change when the delisting happened? Okay. Then after that came the pre-IPO studies, where the other end of the transaction, they started saying, okay, so let's look at the trades that happen before the stock goes public. It's not liquid, it's not marketable at that time. And then what happens after the IPO occurs, when it is listed, it is being traded. So there's a substantial number of pre-IPO studies. So delisting studies on one end, when the publicly traded stock goes dark, and the pre-IPO studies where the untraded stock starts trading. Okay. Now, both of them have some methodological problems. With a delisting study, typically the firm that gets delisted either is being acquired by another firm where there might be premiums involved, or is being in financial problems, or has some regulatory issues that came in, so it's getting thrown out of the market. Or if the price drops below $1 in the US markets, below $1 continuously for a period of at least 5 days during any 90-day period, the exchange can tell the stock company to go home. It can say you are delisted. On the other hand, pre-IPO, before the IPO happens, it's a different business. It could be highly speculative. It could be getting sold at a big discount. These could be the stock options granted at that time. Could be a function of somebody, they want to recruit someone, they want to bring in a CEO, they want to bring in a CFO, they don't have enough money to pay them. So they might be paying them with this stock, which is, as there are filings that have to be made, would be at a relatively substantial discount from the price after the event. So there is, just accepting that to be the DLOM, there is a problem. The third one, where we have a simultaneous observation of the unrestricted and the restricted stock at the same time, when it's a big advancement in the quality of data, which are those restricted stock studies. And that is where an existing trading firm is issuing stock which is restricted from immediate trading. And that is something which is very useful because we have now two prices that we can observe in the market right at the same point in time. And it's a functioning company, which is a very big plus. And of all the methods up to this point, I would say restricted stock studies may be the most reliable method because you have two simultaneous observations and you can say how much is the discount. Except there's one issue that comes in, and which till very recently, I would say till about even 10 years ago, was a big problem. That is that these restricted stock studies that we have occurred over a very long period of time. We have, like for example, the Stout data set that starts in the 1980s, comes all the way to, they keep on adding to it, which is a very good thing. But it has a relatively small number of transactions. So when we start looking at transactions in a particular industry or in a particular time period, we may have a very small sample of 5, 7, 10 transactions that are available. Second thing that happens, if we take all of these historical transactions that occurred, they have occurred at different points in time. The SEC regulations have evolved over time. We started with a 2-year restriction period, which came down to 1 year, which is now 6 months. The market liquidity has changed over time very significantly. The volatility keeps on changing. It's episodic. There are times when markets are very volatile, the markets that are less volatile. And Stout does try to make some information available about the VIX, the volatility index, and they try to incorporate it. So the other one, the study that is put out by Espen's group, they also have a large number of observations. They have larger number of observations than Stout, but they include many more observations which Stout would exclude because there are other things happening at the same time. Once again, good data, applicable. If we did not have something superior available, that would be where I would use that. Except what has happened? Over the last 10 years or so, especially I would say since about 2010, 2012, when a large number of aggregators came on the market. So SEC changed the rules, so all filings are now done electronically. So those XBRL files are publicly available, no charge, and you can go and cull data from there and put it together. Okay. Now, with that, we have the ability to use option-based models because what happens? With an option-based model, we can exactly duplicate the time, the industry, and the size of the transaction to see what would be the applicable discount that would be occasioned at that point. So here's a whole question that you need to answer so that you can get your CPE credit. So we'll stop for a minute and let people catch up, respond.
Hello,
So
Dr. Abbott. Oh, sorry.
yes.
I thought you were stopping. You don't need to stop during the poll question.
Okay.
Okay.
Thank you. All right. That's excellent. That saves a little bit of time for us to work on. Now, there are two option models that have been used. One is the first one that Sheffy essentially introduced, a put option using a Black-Scholes option. And then it's interesting that at about the same time that Black-Scholes presented their first option model, which is the fundamental option model right now, and an equivalent model was put together by William Margrave. He was at Wharton at that time. Now he's in private consulting. So with the Margrave option, he relaxed the restrictions that are in the Black-Scholes model. In the Black-Scholes model, you have to have a risk-free asset. So essentially, you can either buy the stock or buy a guaranteed bond, like a treasury bond, and buy an option which you can at that point in time when it's time to buy the stock, you have the ability either to exercise the option, that is, take the money from the bond, pay it to the stockholder, take that stock, or more important, you have the ability to not to exercise that option. You can say, hey, the stock has fallen in value. I'm better off just taking my money out of the bond and holding it rather than buying your stock. And here's the crux between these two models. When you buy a restricted stock, you do not have the option to not to convert it into unrestricted stock, irrespective of what the price of that stock is at that point in time. It's like a forward contract to buy something. The date comes, the restriction is lifted, the stock morphs from unrestricted to restricted stock. Simple. You're done. Now, Margrave built on the Black-Scholes model and created an exchange option. That is, how many shares of the one asset would you be willing to give up for one share of the other asset? When, very important, when the future price of each of the assets is not known. That is the big relaxation from the Black-Scholes option model. Black-Scholes option model, you always know the bond's value, and you have a choice whether you are going to exercise or not. With a restricted stock, you have to pay a certain percentage of the unrestricted stock's value, and then you do not have a choice on whether you convert it to unrestricted or not. There's no money risk-free asset that you can take home. That is a critical difference. Okay. So using that, there's no price protection. The price of the unrestricted stock is unknown at the time. In future, we don't have a time machine. So with that restriction, a Margrave exchange option becomes an excellent way to see what is the current value of the restricted stock as compared to the unrestricted stock. So it gives us a good model to see at what discount should this be trading. And it's later on in the presentation, I'll show you. We applied this model to the stout data, and we find that when the stocks are in their categories, depending on the transaction, the numbers that the model predicts and the numbers that are actually observed are very close together. The means for most categories are almost within 1 or 2% of each other. Okay. That's the power of data being available, where you can actually translate what's happening in the market into a dollar or a percentage number. Okay. So basically, we have this is the theoretical assumptions. You can read them at leisure. Basically, one of the things that some early practitioners, or what I should more correctly say, early practitioner authors that started looking at the models, some of them came up with this concept that, oh, these models give a discount which is more than 100%, and therefore something has to be wrong with the model. What some of them at least failed to understand was that the discounts can never be greater than 100%. So discount is more than 100%. That essentially means that you would give the unrestricted stock in exchange for restricted stock at some point in future. But right now, the restricted stock is so toxic that someone would have to give it away and give somebody some money to take it off of their hands. Rather, um, illogical is a too harsh a step, but something that does not really make sense. Okay. So here we theoretically show that at any time, the discount from the liquid value cannot be more than 100%. Okay. Now, this is something which essentially is part of kind of lack of follow through, because 1995, when Longstaff wrote a short note in JF regarding the option models, look back models, he was just observing that the numbers are close to what the numbers in the business valuation literature are. 6 years later, he had finished a long manuscript, a 2001 paper, where he showed exactly how the numbers work. I mean, why the discount should be a certain percentage of the thing. And there he came through. It's a long section on the price of illiquidity that he puts in that paper, where he shows this particular exercise, saying that, look, the discount obviously can never be more than 100%. This is how to do the discount. And we'll walk through that logic now before we start looking at the empirical numbers. So the exchange ratio is simply a function of the volatility and the time to the transaction. Because what we are doing is we are valuing the unrestricted stock in terms of the restricted stock. Okay. So if the unrestricted stock is $100 and the restricted stock is $80, that means that the exchange ratio is 1.25, right? $80, you are paying for every 4 shares of the unrestricted stock, you are exchanging 5 restricted shares. So the discount is 20%, not 25%, which was something that somehow, somewhere in the early valuation literature, people interpreted this exchange ratio. Okay, this is 1.25. Let's take number 1 out. So the premium, the call premium started in somewhere in their head. They started looking at that as if this was a put discount, which is very different. So this is the number that we'll be working with. Okay. The Maghreb exchange option is the exact equivalent of the Black-Scholes option, publicly traded, efficient market. Everybody knows everything that is public. The component of private information is not addressed in that. So, which obviously the next thing was when this is something which in the 70s, as the oil markets heated up, Bank of Tokyo, that's why this is called an Asian average exchange option. In Tokyo, the Japanese bank, they started offering these options on the oil prices, which were that the settlement price will be the average of all prices during the life of the option. Why was that important? Because what had started happening in the oil market was after the OPEC cartel was formed, they would be selling a lot of these options and then manipulate the price on the settlement date to make a lot of these options out of the money. Okay. So obviously the buyers started moving away from the market. So the average exchange option was introduced by Tokyo. Currently in business valuation literature, we look at that as the Finnerty model because Finnerty took this and put this into a business valuation paper. Has been around for like 50 years. So there, all that was the difference between the standard Margrave option value, and this is that instead of using that sigma, the volatility of daily returns, log returns, we are using the volatility of the average of the log returns, which is smaller than as the number of time periods keeps on getting larger, the volatility starts getting smaller. Okay. So when we substitute the volatility of daily prices by the volatility of the average daily prices for that length of time, we have this Asian average exchange option, frequently called Finnerty model in business valuation. Okay. So this is when all public and private information is available to both parties. So there's no information asymmetry. Okay. The other option, which is before this, is what we call now the long SAP option, which is again, Gold had put this together about 30 years ago. Then 95, Logsap wrote a paper. Then in 2001, he wrote the real big paper that worked this thing through. So this is looking at if the buyer is apprehensive that the seller has all information which the buyer does not have, which in a closely held business is a reasonable fear on part of the buyer that the seller is trying to sell at the highest price that they can sell. So this model says, okay, let's look at what would be potentially the highest price over the life of this option, and therefore assume that the seller is selling at that point in time. Not necessarily that is happening, but that is the defensive position that the buyer will take. Therefore, they will ask for a bigger discount. So these are now the three situations where we are saying, one, both the buyer and seller have only public information, there is nothing private, which is the standard Margrave option. The extension where buyer and seller both have all of the public and private information is what we call the Finnerty option, or is the Asian average exchange option. Then the third one is when the buyer and seller have all public information, but only the seller has the private information, which in a very closely held firm would become equivalently that the seller has all the information, buyer has no information, because there's nothing that is being publicly disclosed. And in business valuation, we end up seeing a very large number of transactions where closely held businesses are being transferring ownership to someone outside. So those are the three levels of discounts that we will be looking at. Okay. So basically all we need here is the two outputs, the volatility and the time to the transaction, when the unrestricted will become equivalent to the restricted stock from which the restriction has been removed. Okay. So we have these two. So where the blockage is when there are no transfer restrictions, DLOM is when there are transfer restrictions. So once we have that, we can use the data. Okay. Now, what has happened? In 2004, SEC started the XBRL program, where the electronic transmission would be accepted as a filing. And by January 2005, all the publicly traded firms had converted to XBRL. Okay. So why is this important? Because the trading volume and the prices are available from the exchanges. The number of shares outstanding and any restrictions that may be on different transactions are available from SEC. So once both of them became equally available in the marketplace, the interesting thing that happens is that about 2010 to 2015, over that 5-year period, several aggregators, private parties, saw an opportunity here. And before this, the data had been provided by the large corporations like this, for example, at University of Chicago, or S&P, which uh, had, through its subsidiaries, kind of a monopoly of the market for this data. But around 2015, you start getting smaller firms, individual entrepreneurs, who started aggregating this data and selling it. I mean, it's now most of the data are available are for relatively low prices through these aggregators. And when we see this data, we start seeing that, oh, really, there is a big change in the liquidity in the marketplace over time. Okay. The trading volumes as a percentage have become higher over time. But for most of the time, the decile 1, the big stocks, have had much greater liquidity than the smaller stocks. Okay. So the stock turnover, except we saw something very interesting happen in 2020. Okay. As the restrictions on the market were lifted, as the free money almost floated into the market, we see the small stocks take off. They became very liquid. And also, like Robinhood and other firms that came in that started relatively low cost trading for a lot of these firms, that contributed to that. But by now, it has kind of leveled out. So, what has happened? The time that you are holding between transactions has become much smaller overall. Okay. So, for a long time, we are looking at things like 3 years, 5 years. So, it was a very long period that the markets, if you bought a small stock, you would have to hold it. But now it has improved very substantially. So taking something from the 90s or early 2000s, translating that into a discount today is really counterintuitive because the markets have really changed over this time. Okay. Same way, the volatility changes episodically. We see that, for example, 2008, 2009, volatility is hitting the roof, 200%. And then most of the time, it's somewhere for the big stocks, it has been below 50% annualized. For the small stocks, it has been around 100%. Okay. So by taking one point at this and then projecting it to another totally different environment may not be very tenable if we are trying to determine the applicable discounts. So let's look at the Stout database because that's readily available, and they were kind enough to share the data so that I could work with it and look at what is happening. Okay. So the period that we use is from 2008 March. Why? Because 2008 March, the last relaxation happened and the SEC required period of restriction became 6 months. So we are looking at data from a time period where it has not changed, because since then that 6 month has been standard. And if there were observations where no discounts were, no information was available, I mean, Stroud calls it 0%, but we are excluding those because we don't know if it was a misreporting or if it was a lack of reporting. Okay. So I find that there were a total of 113 cases in Stroud database that meet this requirement. And then looked at the actual SEC filings for those and saw what was happening. Was it insiders, for example, receiving stock grants, where both sides would be, where we would call the Finity kind of model, Asian average model should apply, where the buyers and sellers were outsiders, and where insiders were selling to outsiders, or there may be some private information available. So this gives us three categories: insider to insider, outsider to outsider, insider to outsider. And then further, if there are any trading restrictions or there are no trading restrictions. So when there are no trading restrictions, we would properly call it blockage. When trading restrictions are applicable, we would properly call it delong. Okay. So let's look at what our analysis of Stroud's database reveals. So we see that here the observed and calculated discounts are shown for each of these 6 groups. Okay. And what we find is that they are significant in each instance. We do find that the observed discount for the blockage situation, where there was no restriction, was smaller in the insider to insider transactions than what would be theoretically, if we take the model, apply it to the known values of volatility and liquidity at that point in time, would indicate. For the public markets, where its buyer and sellers are both outsiders, in case of a blockage, the numbers are very close together. The calculated discount is 7.43% mean, and the mean value for the observed discount is 7.5%. So they are within less than 7/10 of a percentage kind of thing. Okay. Then for the officers' affiliates, there we are seeing that the calculated discount is slightly less, if you look at that, about 1% less than the observed discount. Okay. So the outsiders may have been more careful or more fearful of being taken advantage of. When we see the period when trading restrictions are in place, like for the unregistered stock being sold, okay, there we find that the observed discount, now look at the initially when we were doing no trading restrictions, the observed discount for insider to insider trade was a little bit less than the calculated discount. When there are restrictions which are known, we see that the observed discount is a little bit more. Again, about a 1% difference between the calculated and the observed discounts. Public markets, as before, the numbers are extremely close together, with and without restriction in both cases. What the model indicates and what is actually observed are very, very close together. Okay. And then in this case, once again, the difference between the insiders selling to outsiders, observed and calculated, is less than 1%. So we have a fairly good estimation method for using the publicly available data to see what the discounts should be. Okay. What's the advantage? The advantage is that both parties to the transaction have access to this data. They can readily look at the point in time. They can look at the observed volatility, observed liquidity, and can come to a reasonable estimate of what the numbers should be given those market conditions for that size of the block. And that's important. So now what we have is we have three axes. We have the size of the transaction, we have the point in time, and we have a peer group where there may be the same industry. Okay. So we can classify it around the three axes and then see where our transaction falls, and that gives us a pretty good estimate of where we are going. So this now, what I'm presenting to you today is a practical application of this theory. So what we did was we took this, because now the data are publicly available, they are relatively inexpensive. So what we did was we said, okay, let's put them all together in one place. So there are one of the kind of problems has been with using option-based models is the access to data and the ease of calculation. Okay. So what we can do here is using this calculator, we can solve these problems. Okay. So use real market data, have the three models built in, and then the important thing is you want to be able to match the facts to the assumptions. Is this a transaction which is no transfer restrictions have been placed? We are looking at the blockage. Is this a transaction where transfer restrictions are in place? This is the restricted stock that is being traded. We should be looking at the DLOM model. So the three conditions: insider to insider, outsider to outsider, insider to outsider, and the availability of any restrictions being applied or not being applied. So the 6 categories of discounts can be done at any given point in time for any publicly traded stocks, or equivalently a peer group of such stocks that you choose. Okay. Are there any questions so far? Okay. I didn't see anything in the chat box, so we should be okay. If there's anything, I mean, this is the time before we start looking at an empirical illustration of what is happening. This would be the right time to ask any theoretical questions that somebody might have. So if there are, please feel free to either let the moderator know or put them in the chat box, and we can then start working with it. Okay. So the solution to those is that this is an online utility. You do not need to download 40 million observations for which you may or may not have space on your machine. You do not need any software to sift through them, to use to create volatilities, to create their classifications. All of that has been done for you. This is something which you can use on a desktop or a laptop or even on a smartphone. So on the fly, you can use this, and you have the ability to go in and look at a particular point in time, a particular block size, an industry, or if, for example, you're using something like the guideline public companies model, you can even take the tickers from firms that are publicly trading, that are in your peer group model, and say, okay, for this stock at this point in time, for this block size, what would be the discount? Depending on if this was a blockage situation where there were no trading restrictions, it was unrestricted stock, or this was restricted stock, which would be being traded at that point. So we would have to figure in the delay that the liquidation would start with. Okay. So there are two ways to use it. One is for exchange traded firms, it is very simple. You put in the ticker the block size, and the year and month of valuation. This is not done on a calendar date. This is done for calendar months for each of the time periods. And you have the discounts available to you in a, I would say, takes, depending on how many people are using it at that time, takes anywhere from 6 to 10 seconds to get your results. Okay. For the non-exchange traded, you would say what the estimated market value is so that it can be placed in the appropriate decile 1 through 10, the 2-digit SIC code to appropriate industry grouping, block size, obviously, and the year month of valuation. Once you enter those in, click on submit, and you have both the blockage and DLOM estimates for each of the 3 models. Okay. Now, there is a little bit of, it will take a couple of minutes for you. Go to this link. You can use this link from your screen. Create your own account. So nobody else will see what estimates you have done, whether it's using a publicly traded company. So this is your private information which stays there. Okay, that is not being shared with anyone. So you can create your account, and then as of now, it's free forever. And as long as you have the ability to do it, at some point, NACVA is going to take over. They will start bundling it with other data products. But at this time, it's open in the marketplace, and you can just go ahead, access it. You don't have to download anything. You don't have to commit any space on your machine. You don't need any programs to run it. It's all done for you. Okay. So go ahead, start creating your accounts. I will wait for a couple of minutes. And when I see a message from someone in the group, in the chat, saying that yes, they are ready, I will go to the next screen and where we will start running this model. Okay, I have a response. I will do this later, currently on my iPhone. That's, you can obviously do it later, but you can do this from an iPhone also. So there's no restriction on that. It's available. Okay. Once someone has created one, we'll go to the next screen and start using it and seeing the results in a moment. Okay, all right, we have that. So let's go to the next one. Oh, okay. Link does not work on my iPhone. Okay, has anyone else tried it? So, let me try. I will try to go on that link and see that. Okay, if it's not working like that, just copy it. Yeah, so let me move this screen to the shared screen. Okay, can you see my screen where the login screen is on?
Yes.
Excellent. Let's do that. So I will submit. So it has logged me in and the calculator is on. Okay. So give me some inputs for this. I mean, this is the data that are available are from January of 1995 to December of 2023 right now. The new next data are being added for 24. Pick a day, pick a month. Okay, I'm picking then 21 May. Market value, let's say million, SIC code 54, block size 10%. And you click submit. And here are the set of tables. So the value that we put in was in decile 7. So that is what is happening. The low value, the 25th percentile, the median, and the high value. They are all shown here for each of the volatilities and the liquidation period. Okay. This is no restrictions. So under the Asian average model, we have the discounts relatively low. This is a higher value. And then under the Maghreb exchange, where both are outsiders, both are insiders, for Asian average, and then for the look back period, we have the numbers. So same way, that was for the size group. Then the next one is for the industry group. Okay. Once again, we have the three numbers, set of numbers. And then here is the interesting part. We have only one firm that is in that size and in that industry at the same time. So you have a note here saying a small number of observations. Please use the data with caution. Okay? And that's a very small number. So now, this was the blockage option. So where there were no trading restrictions. Let's switch that to DLOM, where there are trading restrictions using the same set of inputs. And there we see that the discounts obviously are higher because now you are delaying the liquidation by that 6-month period. Okay. So for the American option, for the Maghreb option, and for the look back option, we have the three sets of discounts. First, for the size group, which is obviously very large. Then we have the industry group, which is relatively small. And then once again, the intersection portfolio is extremely small. There's just one firm. There may be cases where, given the size that we put in, there may not be any firms in that industry. So the intersection portfolio might be empty. And when that happens, obviously you have to see which of the two is a more important factor in your analysis. Are you looking at the size? Are you looking at the industry for the firm? Equivalently, we have the ability to go to specific SIC codes. Here is a list of those so that it shows you, if you do not know the SIC code, what the code would be for the industry that you're looking at. And of course, the second option, when you have a ticker available. Once again, we put in, let's say, July 22. Give me a firm, a publicly traded firm that you would like to see the results for. Let's call it Apple. And the block size, let's make it 5%. Submit once again. And we have the answers. We know what the blockage discount would be and the DLOM would be under each of the three models. It's very convenient to use, very quick, and all you have to do is create your own account. All the data are private. Whatever queries you run are your own. No one else will look at it. And you have the ability to use it whenever you want to use it. And obviously, if there are any questions, any comments, any improvements that you would like to see, please feel free to send me an email or send an email to Chanda and he will pass it on to me.
Yeah, thank you, Dr. Abbott.
You're very welcome.
Thank you for this presentation and for all your hard work building up this online tool. So
yeah, it has been in development for about 6 years now. So.
Okay, so and it's for free. So
it's for free, and something interesting, well, especially from your perspective. If the data are available from a different, this is all, of course, based on the US markets.
Yeah.
Amex and NASDAQ. But if the data were available from any of, like from the Frankfurt market, Paris Bourse, the Netherlands, any market that the data are available, this model, all we have to do is add an option for using the data set, and this model, this software will work. We are working with BVI UK right now to look at the London Stock Exchange. They are looking at putting the data set together. So you could use that data if you're in UK. Similarly, if you would like to use the Frankfurt data or the Paris or any of those regional exchanges, the data are available, this model can be used.
Perfect. Sounds great. So, any questions from the audience?
So it's not a black box, it's something which is ready, available, and is here for you.
Yeah, thank you, Dr. Abbott. Our next Around the Valuation World Show International will be held on June 24th with an economic update from Simon Rubenson from RIX. He will join us in June. And yeah, thank you for attending today. Thanks again to Dr. Abbott and Chanda for the support and the presentation. And would be great to welcome you in June again. Thank you.
Thank you.
Thank you.